Hi, I want to go over what I think some of the highlights are of Chapter 7. This chapter, in many ways, is so much into the future for a lot of you. It's hard to appreciate some of the lessons and the ideas taught in this chapter. For almost all of you, at some point within, let's say, the next 10 years, you will probably be in a situation where you're contemplating purchasing a home, and a lot of the ideas in this chapter would be good to know when you cross that road down, to buy a home. So let me just stress that what I think are kind of three big issues in the chapter. One is this big decision that you have to make, which is rent versus buy. And I understand for most undergraduates, that's really not a relevant decision right now in your life. You're just going to be renting. You're in the New Brunswick area, or you're just fairly recent outside of college age, and you're saving money right now, potentially save a down payment, but you're really renting is the only relevant choice. At some point, you'll have to make that decision about rent versus buying. It is not the case that buying is always the more sensible decision, and that's not just because of the financial downturn we experienced in the last economic downturn in 2007, 2008, where housing prices in different parts of the country collapsed 40%, where housing was a very difficult asset to own. But if you live in a large city and have large rental units, like New York City specifically, you can potentially get a really good rental deal, and buying is just dominated by renting. Traditionally, you should think about these guidelines, which would be you should spend no more than about 30% of your take-home pay on housing. Or another way to think about that would be no more than 2.5 times your annual income. These are two common metrics of how much you spend. One of them's after taxes, one of them is before taxes. So let's just say you get a job out after you graduate, and in a couple of years you're making $100,000 a year. This would mean you should not purchase a house. These rule of thumbs, that's more than $250,000. These guidelines have largely, although not completely, gone out the window in the last 15 years. Certainly in the 2000s, banks were willing to lend you a lot more money than 2.5 times your annual income, and many people did it. It probably is not financially sensible to do so. If you're buying a house and you're not a speculator, let me stress that it is not a good thing to become house poor. And by house poor, I mean essentially your house payments take up so much of your after-tax income that you really can't afford anything else. And that's a difficult position to be in. Some of the pros and cons of renting versus buying. The big advantage of renting is that you have a lot fewer responsibilities for maintenance, and your financial commitment is so much less. It's way easier to move when you're renting. The big disadvantage of renting is that you don't get tax benefits. The U.S. tax system, the federal tax system, is designed to encourage home ownership. Whether that's a good thing or bad thing, we could have a long conversation about. But right now, we're just going to take that is a characteristic of the tax system, and you can write off your home interest, and that can be pretty substantial. Another big disadvantage of renting is if you own pets, it can be difficult to find rental units that allow you to have your pet. On the buying side, the advantages, I will say, is that you can get substantial financial benefits, especially in good times. Housing prices tend to rise, perhaps not as strong as stock prices, but I would say on the similar level of housing prices, and certainly very strong in high inflation times. Housing is a good asset to buy. And the tax benefits of owning a home are substantial. The problem with buying a home is that it requires, in most cases, a substantial financial commitment to make the down payment. That limits your ability to make other investments. And it is a misconception if you think that owning a house is going to, because of the tax benefits, going to be cheaper than renting. Owning a house while you're building equity, that is, you're going to start to own, actually ultimately own the house. Owning a house involves expenses. So there's every single year that you own a house, at least my experience is you got to there's things in the house that need to be fixed, and you're the owner. And so it's not just a complete windfall. Many of you have experienced renting in the New Brunswick area. The cost of renting, usually you have to have a security deposit, quite often 1 month's rent. Depending upon your landlord, you can lose some fraction of your security deposit when there's damages to the property. And if the house isn't clean enough, when you move out, they can take money out to charge for a cleaning person. You typically have to pay utilities beyond your rental payment. So you might have a $600 rent month to rent a room in New Brunswick, but you also have to pay your share of electricity, heating, and water. Water is often covered in the rent of an apartment, but not always. Some students will get renter's insurance. It depends how much property you own. Just remember, if you don't have renter's insurance and something happens, you will be responsible to make those payments. Second big issue is really, are you ready to buy a house? And I've just written down how much can you afford, but truthfully, it's more than that. You have to make a decision about where you want to live. New Jersey's towns are extremely diverse. You can live in Princeton versus New Brunswick versus Highland Park, and all three offer you very different amenities. So you have to make a decision about where to live. That's a big decision. You have to decide, have you saved enough money to buy a home? And then buying a home is probably, for most people, the single biggest purchase they're going to make. And so that's kind of a psychological ready. Are you ready to take on that kind of financial responsibility? The big advantage, or one of the big advantages beyond building equity in your home, is this ability to deduct property taxes in your mortgage interest off your taxes. That is really a big benefit, especially in the first period of time where you own the house. So if you have a 30-year mortgage, the first 15 years, the mortgage interest is substantial. So the write-off of it's really substantial on your taxes. And then you hope in the longer run your house is going to increase in value. Drawback of owning a home is financial uncertainty, and that is it's now we've gone back largely to normal times and how banks finance homes. You need to obtain money for a down payment, which means probably in most people's case saving money, which takes a number of years. I know in the case of my wife and myself, it took about 5 years to save enough money to make our down payment. You have to work out and get mortgage financing. And a big uncertainty is, what if house values drop? There were people who bought their homes in 2006 and 2007, and with the housing market downturn, found that their house was worth 30% less than the price they paid. There was a story not long ago in the Washington Post of someone who bought a home, and it was worth half of what they paid for it about a year after they purchased it. That neighborhood particularly had a large decrease in housing prices. That's difficult when you are paying off a home mortgage when the house is worth a lot less than your mortgage value. The book talks about limited mobility. I will talk about that. I think your mobility is complicated. When you want to sell your home, say to move for a new job, it can complicate it and be very costly. If the market's hot, you can sell your home within a few months. It can be the case where it can take literally a couple years to sell your home. In the meantime, you're making the payments, even though perhaps you've relocated for a new job, you're still having to make your home mortgage payments. And as I said earlier, there are a lot of costs associated with owning a home that when you're a renter, you don't appreciate. The roofing, furnace, refrigerator, everything comes to the homeowner rather than the renter. The big issue number 3 is when you get to the time where you're going to purchase a home, you need to come to the grips about several financing issues. The first issue is how big of a down payment can you set aside? Traditionally, 20% was the number banks were looking for, and the reason why is in most cases, if you have a down payment of 20% or more of the value of your house, you do not have to pay mortgage insurance, which is often goes by the abbreviation PMI. And so if you only have 10% down, you will be paying beyond your mortgage to the bank. You have to pay additional fees each month to basically cover the extra risk that you pose to the bank because you have less than 20%. When you get your equity above 22%, this insurance, this PMI terminates, but that can easily be, in some people's case, easily 10 years of owning a home, and you're still paying the PMI insurance. So that's an extra cost. Home loans, unlike most other loans, can be extremely long. Home loans can be range from as short as 10 years as a real short loan. When interest rates are very low, like they are right now, people are trying to get 15 or 20-year loans. And when interest rates are higher, or they are buying a larger home compared to income, can be 30 years. In Japan, when housing prices were extremely high, Japanese banks were offering 100-year loans. So you're buying a home where there was no chance you were going to pay it off in your lifetime, and in fact, it would be your children who pay it off. One thing I mentioned in an earlier chapter, and I do want to mention it here in terms of getting a loan for your house, is that you will get a lower interest rate the better is your credit score. So let me emphasize one reason why it's so important that you do not get into large and persistent credit card debt is that lowers your credit score. And while you may be able to think you're doing fine in your early 20s, literally 5 years later, when you come to look to buy a home, you will find that your credit score is still being penalized for your credit card debt from 5 years earlier. So you can save substantial amounts of money, a percent or more lower on your home mortgage if you have a high credit score. When you go to the bank and get your home mortgage, they're going to talk to you about fixed rate mortgages and adjustable rate mortgages. Fixed rate is kind of the traditional product, which is they tell you we're going to give you a 5% or 4% or 7% interest, and that's the interest rate for the entire term of your mortgage, so maybe 30 years. When interest rates got quite large in the late 70s, fixed rate mortgages were very expensive. And so banks introduced a product called variable or adjustable rate mortgages, and that they became very popular. And that is, they will offer you a mortgage, maybe they'll say 3%, and it's guaranteed only for the first couple of years. And then as interest rates rise, the interest rate on your mortgage will change over time. And so that creates a little more risk for the homeowner, but usually the advantage of an adjustable rate mortgage, often referred to as ARM mortgages, they allow you to start off usually with a lower interest rate than a fixed rate. So you often can save 2% on your mortgage in the first few years because you have the adjustable rate portion of it. So that's why it's very attractive for new homeowners, because the upfront interest rate's very low. Let me comment on two other types of creative financing that is relevant for many homeowners. One is called balloon mortgages, and the other one's called interest-only mortgages. I would encourage you not to consider either of these products. A balloon mortgage is instead of a 30-year mortgage, you make fixed monthly payments. So sometimes these monthly payments would be as if you have, say, 25 years, 30 years to pay off the mortgage. But then, not after 30 years, but after, say, 5 years, you're expected to make this big, large payment and pay off the entire amount of the loan. So basically, it's called a balloon mortgage because it's this giant payment due at the end of 5 or 7 years typically. And so, again, the advantage of it is it allows you to get into a more expensive home during these first few years when you can't afford a large, the true cost would be to have a regular mortgage, but then you have the hook that you're going to probably have to refinance for sure after 5 or 7 years, or you will have to come into a lot of money to make the balloon payment. So basically, balloon payments for 90%, 95% of people who do them mean you have to do a refinancing of your home after 5 or 7 years. And so it extends the time for you to pay off your mortgage. Interest-only mortgages, are another way for people to get into larger homes, more expensive homes, and in some ways they can afford. And that's because rather than paying off your interest and your mortgage, you only pay interest. Literally, you're not paying any part. So if you borrow $150,000 for a house mortgage, you only pay the interest on the mortgage. And as a result, you never work down the $150,000 you owe the bank. And so people find themselves after paying payments for 5 years that in fact their home mortgage has not moved at all. So again, these are both ways that basically lock you into paying the banks for longer periods of time. Sometimes they make sense when you use a certain neighborhood or town you really want to move into, but if you can avoid balloon mortgages and interest-only mortgages, you're probably going to be on better financial footing. The final thing I'm going to comment on the housing chapter is many people, once you've built up some equity in your home, and that is you have a home mortgage for $150,000. Your house has gone up in value. It's now worth $300,000. The difference between what you owe the bank on your mortgage and what they've assessed it that it's worth, that difference, they often allow you to borrow because they have the collateral of the home. That is, if you stop making either your second mortgage payment or your primary mortgage payment, they can go after your home. Some people refer this to as second mortgages. Some people call it a home equity loan. Again, there are cases where it's necessary. The advantage of it is it gives you some financial flexibility, and the interest in most cases is tax deductible. It's treated by the IRS like a regular mortgage interest, which is deductible. But the problem is it means that you're not working towards paying off your mortgage, and your goal should be to become financially secure and independent, which would mean having no debt, and that includes your home. So the more you're taking these additional mortgages against your home, unless you're putting it into the house, it probably means you're spending too much relative to your income. So I would try to encourage you to not do that. That's it for my main points from Chapter 7. Good luck.